Welcome to the deep dive. Today, we're looking at, well, a really intriguing proposition. It's an investment opportunity in oil and gas exploration.
Mm-hmm.
But it's not just about the usual conventional stuff. This one has a fascinating potential angle in the hydrogen market, too.
Right, that's the kicker.
We've got the documents, the inside track, and we're going to break this down from, an investor's perspective,
Right.
thinking about the money, the potential upside, and of course, the risks.
Exactly. We've gone through the exploration agreement, financial bits, operational updates, all related to Purdy Oil, LLC, and a potential partner.
Okay.
And crucially, like you said, we're keeping it focused. So we stripped out all the specific place names, area, city, state gone. We want to look at the opportunity itself.
Makes sense, like a template for this kind of deal.
Precisely. Our mission here is just to give a clear, kind of sanitized look at what this venture involves.
Okay, let's dive in then. So Purdy Oil, LLC, they're the operator.
Yep.
And it looks like they've already done some work. There's this Purdy Farms, #OneWell.
That's right. Drilled back in 2022, went down to 10,000 feet.
Wow.
And they've got casing cemented in place, and the logs show, well, 4 potential zones for oil.
4 zones already identified. Okay. And the plan seems pretty structured.
Very much so.
Yeah.
It's laid out in 3 phases, basically.
Phase I.
Phase I is straightforward completion, taking that existing Purdy Farms #OneWell and getting it ready to produce from those zones, the J-Sand, Wolfcamp, and Admire A and B. Pretty standard targets.
Right. Tapping into the known conventional potential first. Makes sense.
Exactly. Get the ball rolling with what you think you have.
But then phase 2, that's where it gets a bit different, isn't it?
That's the hydrogen angle. It involves drilling deeper in that same wellbore, another, 700 to 800 feet,
Just a bit further down.
specifically looking for hydrogen gas, taking core samples, testing it out.
Which is, well, pretty forward-thinking for an oil and gas project, right?
Well, absolutely. I mean, the energy world is shifting. Everyone knows that. Hydrogen is a big part of that conversation. So if they actually hit significant hydrogen here, well, that could totally change the game for this project's value. It positions it differently.
Beyond just oil and gas. A bet on the future, maybe.
A calculated one, I'd say. And then there's phase 3.
Right, the bigger expansion.
Yeah, drilling a whole new offset, Purdy Farms, #2, designed differently too, 7-inch casing.
Why the bigger casing?
Flexibility. It allows for multiple horizontal legs, you see, so they can target those oil formations again, horizontally this time.
Okay, more efficient extraction.
Potentially. And crucially, if phase 2 shows promise, those horizontals could also target hydrogen zones.
Ah, so phase 3 leverages success from either phase 1 or 2, or both.
Exactly. It's layered. Start conventional, test the hydrogen with a manageable cost, then decide on the big expansion which could exploit either resource. It's smart, less for adaptation.
Okay, makes sense. Let's talk money. What's the entry cost for a partner, that initial investment?
Okay, the agreement spells it out clearly. The partner, the investor we're focusing on, needs to put in $2,700,000.
$2.7 million, upfront.
Up front, upon signing the agreement, wired straight to Purdy Oil's Wells Fargo account. They even list the account number 230118887.
Okay, pretty specific. So what does that $2.7 million cover exactly?
That amount is specifically the partner's share for completing the Purdy Farms #OneWell, getting it producing oil, phase I, essentially.
Got it. And what's interesting is Purdy Oil's role here.
Yeah, this is potentially attractive. Purdy Oil gets carried for all costs right through the completion of that first well.
Meaning
The partner's $2.7 million covers all the costs to get that well finished and ready for production. Purdy isn't putting in cash at that stage. They shoulder the risk until it's potentially producing.
So the partner provides the completion capital. An interesting risk-reward balance there.
It aligns interests, in a way.
And the total budget for getting through phase I and that hydrogen testing in phase 2?
The combined estimate, which includes buffers for legal stuff, settling some debts, and a contingency, it comes out to $2,700,000 by 5 cents.
0.5 cents, that's precise.
It suggests they've really sharpened their pencils on these initial costs, doesn't it?
It does. So within that $2.7 million, how much is earmarked just for the phase 2 hydrogen exploration, that deeper drilling part?
The estimate for just that phase 2, work the extra drilling and the coring for hydrogen, is budgeted somewhere between $315,000 and $554,000.
Okay, so maybe $500,000, give or take, out of the total $2.7 million.
Roughly, yeah. So for a relatively contained slice of the initial investment, the partner buys that hydrogen optionality, a chance to see if that pans out without a huge upfront bet just on hydrogen.
A measured step into that potential. Okay, now looking ahead, phase 3, The new well, the horizontals. What kind of numbers are we talking about there?
That's a step up, for
Mhm.
sure. Drilling and completing the new Purdy Farms #2 location itself is estimated around $3.5 million.
3.5 mil for the vertical well.
Plus, you've got leasing, geology, geophysics, costs about $177,000 per well location.
Okay.
And then each horizontal leg branching off that well, estimated at another $1.7 million each.
So potentially multiple horizontals, each costing $1.7 million on top of the initial $3.5 million plus extras. It adds up quickly.
It absolutely does.
Yeah.
These are significant capital decisions, obviously triggered only if the earlier phases look good.
And what if phase 3 shifts more towards hydrogen? If phase 2 is a success, how do those costs change?
Well, that's where the numbers get potentially much bigger, but so does the potential prize, maybe. Early estimates for hydrogen-specific horizontals. They range widely, from about $4.08 million up to maybe $10 million per horizontal.
Wow, $4 to $10 million per leg. That's a big jump from $1.7 million for conventional oil horizontals.
It is. The agreement notes they'd provide a much more detailed estimate if Phase 2 actually proves up commercial hydrogen. So the hydrogen path means potentially higher costs, but, maybe much higher long-term value if it works out.
Higher risk, higher potential reward on the hydrogen side. Okay, makes sense. Let's flip to the other side of the coin, returns. What does the partner get back for this investment? What's the cash flow split, the ownership stake?
Okay, so if Phase I is successful, they get that first, producing oil. The partner receives 50% of the cash flow generated.
50%, straight away.
Yes, but only before what's called payout.
Payout, define that for us.
Payout is defined as the point when 100% of the costs to complete that well, plus ongoing operating costs, have been fully recovered from the revenue.
Ah, okay. So once the partner gets their initial investment back, plus operating costs covered.
Exactly. Once payout is hit, the partner's share of the cash flow drops to 25% for the rest of that well's productive life.
So a faster recoupment up front with the 50% than a smaller, longer-term share. Seems logical. How is the actual ownership, the working interest, determined?
The working interest, or WI, is tied directly to the money spent. It's calculated by taking the total costs for exploration, drilling, and completion to get a well producing, and dividing that total cost by 25.
Divided by 25. Interesting formula.
Yeah, that's the specific formula in this agreement, and it applies to each well drilled in the venture. So your ownership percentage directly reflects your capital contribution to bringing each specific well online.
Okay, clear link between cash in and stake earned. What about royalties? The landowner's cut.
Standard stuff here mostly. There's a 12.5% landowner royalty.
12.5% off the top.
Right. And there's also an additional 12.5% overriding royalty interest mentioned.
Another 12.5, so 25% total royalties.
Correct. Total royalties are 25%, which means the net revenue interest, or NRI, what's left to be shared by the working interest owners, is 75%.
Okay, so 75 cents of every dollar generated goes to the partners, split according to their working interest.
Precisely. And the formal legal paperwork, the assignments of that WI and NRI, happen within 30 days after each well is completed.
Good to know. Now, there are some other financial details floating around in these documents, something about projected income.
Yes, there's a line in one of the updates projecting $90 million USD in income for the first month of operation.
90 million in the first month. That sounds ambitious.
It certainly catches the eye. But, and this is a big but, the documents don't specify which phase this applies to or what assumptions underlie that number. Oil price, production rate.
Right, huge caveats needed there. That figure requires serious digging during due diligence.
Absolutely. It's a data point, but one needing major validation.
The documents also mention some legal stuff involving Purdy Oil.
They do. Purdy is the plaintiff in 2 lawsuits related to property and lease acquisitions. They estimate the potential upside, if they win, at around $750,000.
Okay, potential future cash-in. Any other assets?
Yes, they own a company called Archer Drilling, LLC, which apparently has 4 drilling rigs. Those are valued at about $1.9 million total.
So tangible assets, they're the rigs, but are there debts too? Liabilities?
Yes, on the other side of the ledger. They have claims from unpaid vendors adding up to roughly $895,000.
Nearly $900 K owed.
But Purdy believes they can settle these for less, maybe around $500,000. There's also an estimated legal cost of $250,000 to take one of their own lawsuits all the way through a trial.
Okay. And you mentioned earlier the initial $2.7 million budget included funds for legal and debt settlement.
That's right. It's bundled into that Phase I and Tie-I budget. The exact allocation isn't broken out, but the provision is supposedly there.
So a mixed bag financially. Potential litigation upside, hard assets, but also vendor debts and ongoing legal costs. Needs careful assessment.
Definitely part of the risk picture.
Shifting gears slightly, the people involved, there's mention of new personnel.
Yeah, a couple of points. A Trey Dupelchin is listed as a contact in the Satellite Exploration Department at
GCC.
Global Commodities Company. And the documents also list some key people there. Jeffrey Lieutenant, background in civil engineering, international banking. Denise Burkhart, involved in a major studio buyout, apparently. Steve Favis is CTO, and Amber Knight is Chief Operational Officer.
Interesting backgrounds. Banking, big corporate deals, tech, operations. That sounds like a potentially heavyweight team behind GCC.
It does suggest a certain level of sophistication, maybe broader strategic goals than just this one project. It hints at potential scale and resources.
Could signal bigger ambitions. Interesting. Now, for an investor, checking the books is crucial. What rights does the partner have for due diligence?
The agreement gives the partner the right to audit Purdy Oil's books. Full stop.
Okay, important protection.
But it's at the partner's own expense. So the right is there, but the partner pays for it. Purdy also commits to providing unaudited financial statements regularly.
So some transparency provided, plus the option for a deep dive audit if the partner wants to pay for it. What about future deals nearby? Does the partner get first dibs?
Yes, there's a preferential right of first refusal. If Purdy plans to drill another well within a 5-mile radius of this first one, they have to offer it to the partner first.
On the same terms.
On the same terms as this initial agreement. Purdy has to give written notice, and the partner gets 30 calendar days to decide if they want in.
That could be quite valuable if this area proves productive. Lock in the same terms without competition.
Absolutely. It's a significant potential benefit.
Can the partner lose that right?
Yes, under certain conditions. If they turn down an opportunity offered under this right, or if they default on their obligations in this agreement.
So you snooze, you lose, basically. Or if you don't meet your commitments.
Pretty much. And if they do lose that right, any working interest they hold in acreage that isn't producing yet reverts back to Purdy Oil cleanly.
Ah, okay. So stay active and fulfill your obligations to keep that future potential alive. Let's quickly cover some standard contract points. Operating agreement.
Yes, the main agreement says a detailed operating agreement will be put together when this deal is signed. That'll cover the day-to-day with Purdy or their nominee as operator. There's also a standard confidentiality clause last 5 years after the agreement might end.
And if things go sour, disputes.
Binding arbitration, that's the specified route, using American Arbitration Association rules, taking place in Nebraska.
Okay. Costs shared.
Costs of the arbitration itself are shared equally, unless the arbitrator decides otherwise. But each side pays their own lawyers.
Standard stuff. What about acts of God, unforeseen events?
Force majeure clauses in there. Protects both sides if things beyond their control, natural disasters, war, major government actions prevent them from meeting their obligations.
Insurance and liability.
Yep, covered. Purdy has to maintain adequate insurance for oil and gas operations. And standard indemnity clauses. Each party covers damages arising from their own negligence or breach of the agreement. Protects both sides.
And termination. How can the agreement end?
Either side can terminate if the other commits a material breach, a serious violation, and doesn't fix it within 30 days of getting written notice.
A cure period.
Right. If it terminates, outstanding money owed needs settling within 60 days. Again, non-producing acreage interest held by the partner goes back to Purdy. The whole agreement is governed by Nebraska law.
Good to know. Any mention of environmental responsibility?
Yes, there's a specific commitment from Purdy Oil to comply with all environmental, health, and safety laws. Standard but important affirmation these days.
Definitely. And cost adjustments later on, say for phase 3.
Any changes to future well costs or major expansion plans beyond what's outlined initially require mutual written agreement. Both sides have to sign off. Gives the partner control over future cost escalations.
Okay. Now, a really crucial point, who can even invest in this? It's not for just anyone, right?
Absolutely not. The agreement is very clear. The partner must certify they are an accredited investor.
Defined under securities law.
Exactly.
Yeah.
This is standard for high-risk private placements like this. It basically means the investor has a certain level of income, net worth, or financial sophistication.
Why is that required?
Because this is high risk. The agreement explicitly states that. High risk of losing the entire investment. No guarantees of return whatsoever. Requiring accredited status ensures the investor understands and can theoretically bear that level of risk.
Okay. Critical qualifier. So, wrapping this all up, For someone listening, considering this kind of opportunity, what are the main takeaways?
Well, you've got the $2.7 million entry point. That gets you into Phase I conventional oil completion, plus that Phase II hydrogen test. It's a staged approach, which is good risk management.
Hydrogen is an option, not a certainty.
Exactly. The potential returns look decent up front, 50% before payout, then 25% long-term interest. But you absolutely have to weigh the financials carefully. That $90 million projection needs scrutiny, the vendor debts, the legal issues, and acknowledge the inherent exploration risk, plus the uncertainty around the commercial viability of the hydrogen part specifically.
Due diligence is key.
Paramount. Thorough, independent due diligence.
Okay, great summary. So a final thought then. Considering this dual potential oil and gas now, maybe hydrogen later, what strategic edge might this staged approach offer an investor in today's shifting energy world? And thinking like that investor, what specific due diligence questions would be at the very top of your list before writing that check? Something